Okay, all right. So I was trying to get your thoughts on the money market. Where do you think it's likely to trade, considering the fact that some banks may want to ramp up deposits as we end this year?
All right. Thank you so much for having me this evening, Wole. Like you rightly said, if you look at the throughout the year 2012, and we look at the stance of the CBN, going by the rates and the policy decisions, we find out that the CBN is still keen on doing a contractionary policy, saying that they are reining all the inflationary pressure. And we see that if you look at throughout this year, the MPR are stable at 12%. And also in the space of less than 1 year, we see the CRR ratio gone from 4% to 8% to 12%. We've seen the liquidity ratio gone to 30% in this same space of time. So all I'm trying to say is that it's evident, it's obvious that the CBN is trying to mop up the excess liquidity in circulation, and definitely this is expected to cascade to the operations of the deposit money banks. What this is going to likely result in is that as we get close to the year end, you find out that most of these banks are trying to close the position in a very good deposit base. So you find out that there will be a bit of pressure as we get to the year end of the banks, as everybody is trying to have a good position for the year end.
But many people will argue that we used to see this in the past when banks didn't have common year ends, but now that they do have common year ends, the pressure to do that is probably less than it used to be. Your thoughts on that point?
Well, I will probably share a contrary opinion, saying that it's even when you have a year end, meaning that because what you had prior to year end coming was that you have a customer that has the money in Bank A that has a different year end. When it's time for Bank B to get to its year end, you move that same money to Bank B. But what this common year end has done is that you cannot round trip, that meaning that what you have at the end of the year is what is in the banking system. And that is definitely going to mount pressure, like we've seen in the last 2 years, in 2010 and 2011. Towards the end of the year, you probably see a ramp up in money market rate, in the interbank lending rate, and you probably see uptick of about 100 basis points. And we also expect same to happen this year, more especially that we've seen that the CBN is even tightening the money in circulation more, than what we used to have. So we expect that same pressure will be repeated this year.
And for fixed income, your thoughts on how bonds are likely to trade? We've seen, of course, a lot of interest in our markets from foreign investors this year. I think that is something that has marked this year.
For fixed income, our outlook is kind of mixed, saying that we recognize the fact that the CBN is mopping up the liquidity in the system, but we're also conscious of the fact that we have the foreign investors coming into this market, and we've seen what the impact of listing of the Nigerian FGN bond on the JP Morgan index has done. And we also have a feeler, it's clear in the market that sometimes in Q1 2013 that Barclays Capital is also going to list. So in as much as we have people still coming in, the interest is very high. People are still very bullish about the Nigerian fixed income market. So in as much as we have those money coming in, we see the market will trade sideways, and in the Q1 2013, we see that yields will probably come down while prices will go up.